Hi, I'm Peter Rose, founder of Longwood Currency Trading. Why it's better making $200 a day trading Forex than trying to make $600. Well, let's set some parameters to that, because if you're trying to trade with $1,000, you're not going to make either one of those. Let's start with a reasonable bank size of $30,000, or the ability to trade 3 full lots. I think you probably need $30,000 in there, unleveraged and all that, in order to make some significant returns when you're trying to trade. When you're looking at making $200 a day on a $20,000 or $30,000 account, trading 2-3 lots, that's a 0.6% gain a day. That's probably a little aggressive even for a $30,000 account. Again, trading just 3 lots on the leverage. Maybe 0.3%, 0.5% would be okay. 0.3 on be $90 on a $30,000 account. That doesn't seem like very much, but 0.3%, 3 times a week, 3 days a week, is 1% a week, which is about 44% a year. So you can't sneeze at the little money. And that's trading a bank that you think, well, I'm going to risk $30,000. Well, look, you can't go in and trade stocks for under $25,000. There's a patent. It's called patent day trading rule. So they don't even want you in the stock market if you don't have $25,000 to trade. So I don't know where y'all get off thinking that you're going to replace your job income on a $1,000 account, or getting in there and trading a $500 account, or even a $10,000 account. You're not replacing your job income unless you want to take the risk of trading at 2 or 500 to 1. And we'll go over that later. But basically, what we're trying to determine is, based on a bank size that's reasonable for most folks that are actually serious and have the right attitude toward trying to make a significant portion of their job income. I mean, if you have a $30,000 bank, you're probably not going to make $30,000 a year or $50,000 a year on that money. Again, at 10 to 1 leverage, reasonable leverage. What could you expect to make in a year? I don't know. I get my accounts up pretty high towards the end of the year, and then I swing for the fence, and that's my problem in trading, and I get taken down significantly. But when you're looking at pushing too hard, that's where the losses begin to mount up. When you try to take a reasonable size against your bank, not only are you reasonable in that trading, but when you lose, you don't lose a lot, and because you're not losing a lot, you can cut it short. So when you're working with a trading plan that's reasonably constructed, with a reasonable amount of money at a reasonable amount of leverage, then the amount of money that you're actually looking to make on a daily basis, and I'm talking about an averaged daily basis, not I'm trying to make $200 today. I'm trying to make whatever I can make. But in the long run, over a year's period of time, consistently making $200 a day. And $200 based on a $30,000 account loss is not a really big loss. And so you're more likely to cut that trade quickly. Not even letting it go to well, if you're trading 3 full lots, 10 pips, that's not $300, right? So you're not even, you've got that set thing in your mind that, well, if I'm trying to win an average of $200 a day, then taking a $200 a day risk isn't too much. So on a $30,000 3-lot account, 10 pips is $300. So you could go to 8 pips, and you'd be at 160, right? So, I mean, you have to base that risk on an amount that doesn't matter in the big picture. Once you start basing that that loss amount, let's say you go to 20 pips. There's a lot of traders out there that say, oh, we got to leave room for price to breathe. Well, if you don't know what you're doing and you don't have good entry analysis, you're going to hit that 20 pip loss a lot. And then when you have a gain, what's our demon that we have to face? Taking the profits too soon. We let the losers run and take the profits too soon. The reason for that is because there's too much money involved, too many dollars involved. It's very hard to trade by pips, which is what I advise people to do instead of trading for dollars, but nobody wants to hear that they're going to make 5 pips a day and retire. But it's possible, but certainly not on a $30 or $40 or $50,000 account. But there are ways that you can magnify those small pip values. You settle on 5 pips a day. Well, when the day presents a 20 pip run, take the run. I mean, setting these targets they're guidelines. They're best practices for planning purposes so that you don't face risk of ruin. If you get a $30,000 account and you let that thing run 60 or 80 pips, how many times are you going to be able to survive? That's a big dollar hit from your account. But that's what happens when you start trading for the $600 a day. Oh, I think I could get $600 out of that trade. Great. Why don't you see how easy it is to get to the $200 mark first, and then if price is still ripping, you can either let the trade run, or you can get out at that $200 profit or $300 profit, whatever you have that's reasonable. And if it's continuing to run, get back in again. But in both cases, letting the trade run and getting out and then getting back in, you're facing that risk of loss again. It's very difficult to give up accumulated gains. You don't want to give those up. For me personally, I've had, I think 8 runners, 8 winning days in a row, and I'm in the 9th or 10th day of that winning series, and I didn't want to take the loss because it would eat into my great percent return for the month, and that son of a bitch ran 12.5 pips against me, and so I'm sitting with this running loss and hoping it'll come back, and because I think the market conditions are going to warrant that, but I'm still shouldn't have done that. I should have said it's going against me, and I'm going to get out. That's our tendency. We fall into those tendencies because the dollar numbers become very great. When you are not encumbered by a big dollar number, you're going to make the right decision because it doesn't matter. Oh, I'm going to make $200 a day, and you get in there, blah, blah, blah. Okay, I got my 200, I'm out, and I'm gone. Oh, I'm in my trade. I'm trying to make $200. Trade's running against me. I've lost $200. That's my average daily gain. I'm out. So now, instead of being a 60-40 trader, what happens is that you now up your win-to-loss ratio to maybe 70 or 74 or 75% win. 70-30 trader. And then you're going to take 3 trades out of 10 are going to be losers of $200. So you're going to lose $600 over those 3 losses. And then you've got 7 that you're going to win at $2,100. Take the 300 off the 600 off the 2,100. That's a massive amount of money and far greater than a $200 return. But that's how you do it. That's the secret sauce. When you try to make more money than a reasonable average daily win is, and remember, an average daily win doesn't mean you're going to win that every day. It means sometimes you're going to lose a lot and sometimes you're going to win a lot, and on the average it comes together to form that $200 a day. So it's not a trivial pursuit. Some days you're going to make $600-800. I had a small trade running the other day. It was I think it was a 3-lot, and I made $800 on it. No, it was a 4-lot. I made $800, $900. I actually made more than that, but I had lost a couple of $100 earlier in that by taking a short clip, and then boom, made quite a bit of money on that. But when you are pushing and pushing to try to make money, you don't want to try to make money. You want to have your rules make the money for you. That's what the rules are for. The rules are for risk management for sure, but what they're geared to do is relax your state of mind in your trading, because you don't want to try to make an unreasonable percent gain against your bank, not only on a yearly annualized basis, but you have to bring that down to just a per trade basis. You might make 50% on your money a year, 60% on your money a year, which, I mean, you get your win-to-loss ratio up and you're following these rules. There's no reason why you can't make that kind of percent. But once you start increasing the size of the gain that you're trying to make as a percentage against the money that you have at risk at reasonable leverage, you are going to fail. Your risk of ruin goes up dramatically. It's like driving your car. You drive your car with your seatbelt on, you don't worry about it, you're relaxed, you're alert to what's going to happen. You take your seatbelt off and you're pushing the envelope on stuff, and that one time that you get caught, and it could cost you your life. So the one time that you decide to oh man, the news reports are this and that, blah, 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 whatever criteria you use in your entry analysis that makes your little addled brain say, oh, today instead of trying for $200, I'm going to try for $1,200 because it's Tuesday or whatever. That's where you're going to get hit, because you're trying for an unreasonable gain, an outlier. Why try for the outlier? Go for the average percent against your bank win that you think is reasonable on a daily basis, that will ultimately average to your average winning value. And when you get there, look at the 5-second chart and manage that thing. And if it goes a quarter of a pip against you, a half a pip against you, just get out. So what if it continues to go? You've preserved your money. And when you do that, you have a tremendous sense of relaxation. Trading for these unreasonable percentage gains, of course, you have to know what those percentage gains are. You have to be able to know how to calculate them and to balance between a daily win as opposed to an annualized win in combination with your win-to-loss ratio. This is all stuff that I cover right away in my coursework with students, because they don't know this stuff and they wonder why they're not successful, or why they're getting started trading and they just can't be consistent. They can't get more money out of the trade when it's time to get more money out of the trade, and they lose too much when they lose. So you have to understand how to build your rules and be able to calculate these percentages as to what's reasonable and unreasonable. I mean, I just can't tell you how important not trading for unreasonable percentages on several different topical areas in the trading is. You got to watch out for that. You also can't trade for too many pips. You have to look at the currency pair that you're trading, the time of day that you're trading the pair, what the current ATR of the pair is, and where are the moving averages, and what's this thing been doing? Are you in a dependable trend over the last couple of days, or are you just trending over the last 20 minutes? Are you in a chop? Are you in approaching a resistance or a support zone where you may have some structural problems from an order flow standpoint? You got an NFP report coming out. What's going to happen to the price? That's trading. You have to understand how to trade, and part of learning how to trade is not to try to trade for too many pips. And what's the too many pips based on? It's based on the gains that you're trying to make on an average basis. You have a size of the bank that needs to hit this number of pips to hit this number of profit. And so if you try to hit too many pips, which I tried to do in this trade that I'm in now, I was going along very happily, clipping 5 pips, 10 pips, and doing great for those 8 or 9 losses. I got in a situation where the price had dropped substantially. They had retraced. It was starting to drop again. I thought, oh boy, this is it. This fucker's going to go right through it's going to go right through the floor. It was a short trade. It's going to go right through the floor. I loaded up a little too heavy in the beginning. It went through my orders. It clicked them all off. It's still going down. I banged in a couple of more. The son of a bitch turned around and went 70 pips or 80 pips against me. And I'm sitting there going, what just happened? It's because I was trading for too many pips. Instead of being happy with a 10 pip gain and making $300, $400 it was at that point, no, I'm trying to make $1,500. I've got it, $1,200, $1,300. It never even got close to that. I was up 400 and the thing just turned around and went against me. Too many pips. You can't. And you have to understand what too many pips is, because it's different for different people. It's different for different conditions. And too much leverage, that's not dependent on anything. Either you understand leverage or you don't. And if you're going to trade at 200 to 1 or even 100 to 1, you're dancing with the devil, baby. You just really are. And if it goes against you, not if it goes against you, when it goes against you, it's a ruin situation. Once you up your leverage, it's a risk of ruin increase exponentially. That doesn't mean that you can't trade with too much leverage. You can, but there's a time to trade with too much leverage. And there's a methodology that you use in order to make sure that your risk of ruin is negligible. And that's advanced trading stuff. Oh, you get these guys that are teaching you this stuff, but you're not grasping the significance of what they're saying. You're just going in there and trying to do it. And you're going to get lucky 4 or 5 times, and you're going to take your $10,000 and it's going to go to $30,000 or $40,000, and you're going to go use that as a down payment on a fucking new car. And all of a sudden, it's all gone. Because you're not the teacher. You're not the trader. They just don't know how to teach you. And they don't know when to teach this stuff. I have students that come to me, oh, teach me how to do this leverage stuff, and teach me, I want to do this compounding, and you're talking about staging and building positions. Yeah, I want to get into that right away. Well, how long have you been trading? Well, I got 6 months and I've been trading. Well, what are the results of your trading? Well, I'm not profitable. Geez, I wonder why. Because you're trying to take your $10,000 account, your $20,000 account, you're trying to make $1,000 a day. I mean, the fact that you could do that maybe 4 or 5, 6 times in a row doesn't mean anything. Because if you can't do that every day, or have reasonable expectation of making $1,000 every day, you shouldn't be doing it. Because every time you say, oh, I just got to take advantage of this for the next few days, well, that statistical likelihood that you're going to win dwindles with each time that you do win. Until you, I mean, that's going to the casino and play pass line craps. It's only 1.41% against you. And see what happens. After the dice get thrown 4 times in a row, 5 times in a row, 6 times in a row, and everybody's piling on. Pass line craps odds, the 7th rolls of the dice and you fucking dust. That's the statistical odds. And people go in there and it goes to 7, it goes to 8, it goes to 9. Oh, yeah, and they're still betting. Can't do it. The odds are stronger than we are. And you have to respect that. So you can't trade with unreasonable percentage gains. And you're probably going to need someone to work with you on that. You can't trade for too many pips. How do you define, Peter, what too many pips is? I can't define it for you because I don't know what currency pair you're trading, where you are psychologically, how much money you've got in your bank, what the time of day is that you're going to trade in relationship to the openings of the 2 pairs. It's just, I can't tell you. But I'm just telling you that you need to be able to figure that out, what too many pips is. And too much leverage, what's that? Well, I'll tell you this, 100 to 1's too much. So if you're thinking or listening to somebody that's trading at 500 to 1 leverage and 200 to 1 leverage, and they're making $3,000 a day and driving around a Lambo with their ball cap on backwards, that's great. Maybe they know how to do that. 2 questions. Can you do that? Probably not. And number 2, do they have the skill to teach you how to do it reasonably? And if they start teaching you how you can just put the position on and let it run at 500 to 1 and make all these gains, they don't really understand trading. And if they do understand trading, then they're consistent, but they just simply don't know how to teach it. And so why would you? Okay, so you've made $1 million trading currencies. So what effect does that have on me? How do I make money? How do I make $10,000 a year so I can increase the amount of income that I have? You know, if I'm working a $15 an hour job, which is the current minimum wage in the United States, and not everybody is following that right now, but $15 an hour is about $30,000 a year. So if you could make $10,000, 30% of your income trading currencies, and you could get comfortable with that, and you made that $10,000, then I can work with you and I can teach you, number 1, we're going to increase the size of your bank, and number 2, we're going to look at where do you use a little bit more leverage? Where do you start compounding? How do you manage your positions better so that you can squeeze it for more money? But not in the beginning. That's advanced stuff. So too much leverage means too much leverage regardless of where you're at. Because too much leverage could be 10 to 1 if you don't know what you're doing. But it gets particularly difficult to comprehend the dangers of even 100 to 1. If on a $10,000 account at 10 to 1, I can trade one full lot, $100,000 of currency, that's why it's 10 to 1. 100 to 1 means I can trade 10 lots on that $10,000. And that 10 lots is $100 a pip. So you get a $10,000 account and you lose 20 pips. 2 days at 10, you've lost $2,000. You've lost 20% of your account in 2 trades. Good luck. So why is it better making $200 a day trading Forex than trying to make $600? I hope you get it. If you have any questions, please send me an email. Maybe I can just throw a little bit of light on it. No charge. I'd be happy to try to work with you and to help you out or to make sense of it. But if you start asking questions on questions on questions, that should tell you that you really don't have enough background to understand or fully comprehend this stuff so that you're going to be able to implement it. And then you're going to need some consulting or you're going to need to take a course. And I'm sorry, it costs money to do that. You want to drive your car, you got to put gas in it. That costs you money. So don't say, oh, I can't afford. I can't afford. You can't afford not to have good training. And you don't have to train with me. I don't care. I don't want to teach people that I have to drag across the finish line. I'm retired. I don't need your money. I retired a millionaire from my 40 years in real estate. I was a software engineer for 33 years. I made good money. I'm happy. I have a lot of interest, and I don't need to try to drag people across the finish line for a few $1,000s of a coursework. My time is more valuable to me than that. So when you are looking at getting involved in the currency market, either you got to figure this stuff out right and make it okay. But if you can't figure it out and you're making mistakes and you're looking at videos from these guys that are talking trash about high leverage and you got to make this many pips, you just set it and let it go for 3 days and everything will work out okay because it's safe trading on the daily, and you can't duplicate that, you've got to find somebody that can slow the horses down and bring some solidarity to the educational process into your life so that you could be successful. There's no reason you can't be successful at this stuff. It's just the education that you're consuming that convinces you that you should be able to do what somebody who's got two or 3 years of experience doing. So don't push the envelope on this stuff. When you lose, it shouldn't hurt. When you win, it should be just like filling your coffee cup up and taking the next sip. As simple as you can make it to create these simple losses and simple gains, the more relaxed you will be and the higher your win-to-loss ratio will become. It's the win-to-loss ratio that's the key. And if you don't understand that and understand how to decompose that win-to-loss ratio into a functional equation that will guide you in the development of your trading plan, you really need to back up of what you're doing and think about, well, what's the market? What am I trying to do? What statistics do I need to know in order to better write my not only my trading plan, but also the rules that go with that? Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.